Good day, my name is Andrew Milligan. I'm Head of Global Strategy here at Standard Life Investments. For readers of our global publications, our house view, how we see the world, you'll know we've been analysing for some time the use of cash by companies. Now, firms have built up very high levels of cash indeed, particularly in some parts of the world like the United States. And they're also starting to borrow more because interest rates are really very low. What are they going to do with this? This is one of the issues that the Global Investment Group and our equity fund managers have been thinking about. Now, one option, of course, is investment, capital spending, business investment. And there are some positive signs, indeed. If we look at some of the economic figures for the United States, for the United Kingdom, actually we are beginning to see capital spending picking up, companies putting cash to work, expanding capacity. Elsewhere, Japan, European Union, not really happening yet, and that's no great surprise, of course, when spare capacity, excess unemployment in many of these countries is hindering the ability to invest. However, we're also starting to see cash being used in another way by companies, merger and acquisitions activity, M&A. Companies taking over other companies, merging, divesting operations and plants to be bought by somebody else. In the last couple of weeks, we've actually seen a number of smaller and indeed bigger names in the press, either actual M&A or talks that are beginning to take place. And we do think this could go rather further. Please do look out for a detailed note which we've written about this in our Global Perspective series, which should be available on the Standard Life Investments website. In essence, we think a noticeable upturn lies ahead, moving out of America, which has seen quite a lot of M&A so far this year, into other countries, and broadening out across sectors as well. Now, why will this happen? Well, we think it's a mixture of better confidence amongst business people, access to finance will also help, and improvement in the economic recovery generally around the world. But there are other issues too. Regulation matters, for example. This can be a driver of merger and acquisition activity, as we discuss in that edition of Global Perspectives for the European telecom sector. Now, how else does the House view see the world at present? In client meetings which I have with people in this country but also around the world, manageable is a key word. There is a problem, but it looks to be manageable. Chinese debt would be one example. It's very well clear to many investors that there are problems there with the excess money supply that we've seen in recent years. Will this begin to cause problems for the Chinese economy? Yes, it is starting to slow. However, the authorities do look to have defences in place, defences against this flood of bad debt which is beginning to engulf the country, the ability to control the banking system, the foreign exchange reserves which they've built up, the ability of the country still to borrow in the markets. So we see a manageable debt problem for China. The Ukraine would be another example, of course. Major worries about gas supplies running through that country to Eastern and Central Europe. Our view, neither side would benefit from an energy shock. The Russian economy is already remarkably weak, even before the sanctions that are being talked about. So again, the situation there looks manageable. European Union deflation. A number of countries in Europe are beginning to see falling inflation, inflation close to zero. Again, no great surprise with the excess capacity that's being seen in that part of the world. However, again, we think the European Central Bank can manage the situation via a mix of policies, interest rate cuts, potentially even quantitative easing going forwards, to make sure that investors do not worry unduly about a further return to recession for that part of the world. So all in all, our house view is modestly pro-risk. We're expecting better corporate earnings growth in the rest of 2014 after a weak first quarter. There are a number of issues out there, the Ukraine, China, deflation in parts of Europe, but we do see those situations as manageable with the authorities able to control the situation at present. And then if we look to the merger and acquisition activity, this looks to be providing a bit of a fillip to equity markets into the second half of this year. Thank you very much indeed.